Folks, if you have not taken the time to go to Instagram and follow Life Goal Investments, I don't know what you're doing. One of his 60-second rants is something we're going to talk about today. Taylor, I'll read you the headline and we will dig into it. This investment outperforms the S&P 500 over the past 30 years with zero negative years. Taylor, what the hell is that? It's pretty
What
awesome.
it what it is too good to be true, right?
Yeah, you're lying, Taylor. You're a Wall Street scumbag. What the heck are you doing?
No, so admittedly, I didn't know this. I knew this combination of assets was a really great investment for a lot of different reasons, and we can touch on them. But I didn't realize how strong the performance had been. So the investments we're talking about here are called real assets. And in the video, it talks about a blend of one third, one third, one third.
Okay.
One third being critical infrastructure. So critical
Like,
infrastructures would be like the Port of Long Beach, California,
okay.
or big data storage facilities, or public-private bridge and tunnels that are between
Got it.
governments and half owned by private entities. So
Okay.
that's infrastructure. Then you're looking at private farmland. So you're
Ooh,
literally buying up
farmland. Okay.
farmland, which acreage it produces both the income by the crops and the
Uh-huh.
appreciation by the underlying acreage.
Mhm.
And then the third piece of it is timber forests. And timber forests,
Ah,
like farmland, same thing, where you have the forest, you have the acreage, and once every 20 years, you harvest the crop, being lumber, and it brings it over. And so the magic of this kind of one third, one third, one third between these real assets is the fact that their growth has just been slow and steady. It has
exactly.
never
No
been
crazy.
absolutely spectacular, right? You don't get the upsides that you get in the stock market. But here's a crazy stat. If you had in the past 30 years invested in this one third, one third, one third, on the worst day in the past 30 years, if you invested in it 1 year later, you were positive 1.5%.
Wow.
Yep. And so you look at that and you go, okay, well, the S&P 500 is this thing that everyone talks about that is the best thing since sliced bread. There's never been a better investment. Just set it, forget it, let it roll. Warren Buffett says to do it, whatever the pundits say. And
Mm.
you look at that, 1 year later, you invest on it on the worst day, you're down 38%.
Yeah.
So
That
it's
so
like,
that's a little worse, right?
yeah, just slightly worse. And so
Right.
here's the other thing that I could foresee people. I just put this video out this morning, so I could foresee people commenting on this. The average return per year for that one third spread that I talked about there is like 10.1%. And the
Mm.
average return over the past 30 years for the S&P 500 is more than that. It's like
Sure.
11.6 or something like that. But it's sequence of returns, guys.
Yes.
So it is, you don't get those massive downsides. And how do you win by investing? It's by
Yeah.
limiting the downside. So, like, again, the numbers aren't just add numbers and divide by two. If you go down 50% in a year, you
Yeah.
know this, Michael, you got to get back
Oh, yeah.
100% just to break even. So when you just grind out slow and higher returns like that asset mix does, it's obviously better outcomes monetarily in the long run. And this even takes you through, obviously, over the past 30 years, takes you through the dot-com bubble in the early
Yeah. Yeah,
2000s.
no
It
joke, right? The last 30
takes you
years, you're in
through
the 90s, man. Yeah.
2008,
Yeah.
takes you through COVID, all of them, never a down year, just kind of drifted higher along the way.
All right, now the hard question. Let's say I'm excited by this. Is there an ETF that I can go get? Is this something I have to cobble together with a professional like you? How does one cobble together a one third, one third, one third?
So, unfortunately or fortunately, depending on, I guess, self-interested, it's fortunate.
Yeah, shocking. I can do it for you.
No, so like we use a particular fund that we invest in for our clients on their behalf, and that
Right.
fund is not investable outside of having a financial advisor, unfortunately. So a retail investor can't go direct and get it. And the way we invest in it too, which is interesting, is what they call an interval fund. So
Oh,
most
okay.
most folks have never heard of an interval fund, but an interval fund is something that intentionally limits liquidity. So what it is you can only get access to your money 4 times throughout the year on a quarterly basis.
Oh,
And the reason you want that as an investor is because, I would rather have access to my money every day, but I don't want you and everybody else in the portfolio being access to their money to take it
right.
out, because they're investing in less liquid assets,
Oh yeah,
right?
timberland,
Timber
farmland.
forest.
Yeah,
Yeah, it's
yeah.
not liquid. So if you were to invest in an ETF where money can come and go every single day, the underlying manager determining what properties they're buying isn't able to go out with any foresight and say, yeah, I'm going to have capital enough to purchase this. And then if the ETF sees a run of outflows on the other side, they're turning and going, oh boy, we're forced seller on this market.
Mm.
This isn't good,
Bad
etc.
timing, bad
Yeah.
lending. Yeah, yeah, yeah.
And
Now,
one of the reasons,
go
go
ahead.
ahead.
I was going to ask, do you have to be an accredited investor to get in this, or just have a relationship with a brokerage?
Nope. Nope. You just have a relationship with a financial advisor. It's not available to retail investors, which again is
Got it.
unfortunate, or I guess fortunate on our end. But the other thing I'll say is like
Yeah.
when these assets really perform well on a relative basis. So
Mhm.
like one, in the past 30 years, we don't even go into the 1970s. But
Right.
if this particular study, which it just doesn't have data that goes far enough back to go into the 1970s, the numbers would be absolutely
Oh
phenomenal
no, if you had the
relative.
70 inflation rip, I mean, come on.
Correct. Yeah, I mean,
Sheesh.
you look at the S&P 500 on a real return basis for the decade of the 1970s. You know what the
Mhm.
return was on a real cumulative
Unreal.
on
Real?
real? Yeah, whole decade.
Oh, I don't think the
The
real was that great. I think nominal was great, but real, I don't know. I'll go, I don't know, 31% for the decade.
-16.
Oh, damn it. I wanted to go lower.
And so that's that. So by the way, that's stocks. And you look at the other side and you're like, okay, bonds protected me. No, we know bonds
No,
don't do well in an
no,
inflationary environment. They were
no.
down at it's either 32 or 33 on a real return basis for the decade. What did really well? Real estate, gold,
Yeah.
infrastructure, farmland, timber forest, oil. Oil did phenomenally well. That was, the
Oh,
cause of the massive
yeah.
inflationary pressure that we had was oil and the embargo that the Middle East placed on us. But I'm
Yep.
officially in a rabbit hole right now. Get me out.
That's I'll pull you out. I think there's a lot of people that watch this. A lot of folks are Gen X and baby boomers that watch this channel. They might be looking for a kind of boring fund like this interval fund you're referring to. If they wanted to reach out to you, how do they do that? Do they go to Instagram and send you a DM, or how do we do that?
Yep. So they can go to Instagram and click the link in our bio, and it'll put you right through on a page to schedule a one-on-one. The other way to do it, and this might be long-winded, but it's lifegoalinvestments.com/introduction.
There you go. Again, go to the website lifegoalinvestments.com/introduction. I
It's a
just
lot.
go to Instagram,
It's
DM him,
easier.
tell him you came from one rental at a time, and I promise you he will take care of you because
Heck
we
yeah,
love
I
these
absolutely will.
weekly
You're the man, Michael.
conversations. All right. Take care. Thanks, Taylor.
Thanks, brother.